Good morning, everyone, and thank you for dialing into our webinar. This is the second in a monthly series of free interactive webinars where we will provide our view on key tax and VAT updates across the GCC. This webinar series supplements our weekly tax flash emails, which are sent out every Thursday afternoon. So if you don't receive those, just flick us an email and we can add you to the list for the tax flash emails. The aim of the webinar is to give you a snapshot of what we see as the significant issues and announcements, rather than any detailed and tedious technical analysis of the tax rules. Your presenters today are myself, Mark Gamble, so I lead the tax practice in Bahrain, Raman Ori, who leads our tax practice in Saudi Arabia, and Tariq Haq, a manager in our VAT team. We will be assisted by two panelists, Dao Han Hung, a manager in our VAT team, and Dinesh Ravi, a manager in our tax team. We do want these Tax Matters webinars to be as interactive as possible. So for us, that means having a conversation rather than lectures. So we do encourage questions. How you ask questions is there's a Q&A widget on your Zoom, either at the top or the bottom of your screen. So if you have any questions throughout the webinar or now, or if you have a list, please start writing your questions now, and Han and Dinesh will answer them as we go through, and we can always answer them at the end. If we don't have enough time to answer your question, we will definitely get back to you by email anyway, so feel free to ask as many questions as you have. All right, let's make a start. Tariq, do you want us to talk us through the NBR updates?
Thanks, Mark. Okay, so last month, the NBR amended the zero rating rules for the construction of new buildings in its real estate guidelines. The zero rate applies to services, such as original survey certificates, layout plan certificates, engineering drawings, and construction drawings of foundations that need to be done to obtain a building permit from the Ministry of Works, Municipalities and Urban Planning. Now, these amended zero rating rules took effect from the beginning of this month, so that's 1st of October 2020. If you're dealing with VAT returns for construction businesses working on new buildings, we suggest you carefully look at these items on invoices to ensure that they are correctly standard rated or zero rated. Mark, do you want to maybe talk us through the advantages and disadvantages of zero rating provisions?
Yeah, I mean, look, to be honest, it's difficult to think of instances where the zero rating isn't the preferred approach. It's better for cash flow, obviously. The supplier doesn't need to fund the VAT element on the supply while it waits for payment from the customer. And I guess in these building construction contracts, it sometimes takes a while to receive the funds from the customer. So there is that cash flow implication when VAT's involved. From a customer's point of view, if they're VAT registered, then they can recover the input tax. So it's not really a cost as to whether it's zero rated or 5%. But if the customer's making exempt supplies, or if they're not registered, so say you or me buying something in a shop, then the VAT does become a cost. So it's actually better to have a zero rate. So, I mean, look, ultimately, I think it's better if you can get a zero rate to apply, but the tricky thing is the rules, you need to make sure you get the rules correct, because if you don't apply the 0% correctly, you can be hit with some pretty heavy penalties. So I guess to conclude, it's a good thing, but make sure you get it right.
Okay, thanks for that, Mark. So now talking a bit about economic activities matching the MOICT. So the NBR has asked taxpayers to ensure that economic activities recorded with the NBR are aligned with the economic activities listed on Bahrain's company's commercial registrations. Some of you may have received emails from the NBR asking for this information to be updated. We'd strongly advise you ensure your economic activities that are mentioned on your CR are accurate and that they are aligned with the NBR's record as well. Non-resident refund scheme, we'll talk a bit about that. The non-resident refund scheme is now open. We covered this in depth in our last webinar. But if you have companies incurring VAT in Bahrain that cannot recover as they are not registered for VAT, normally when they're non-residents, this refund scheme may be relevant for them. So if you've got any related companies, that may be something you should consider passing on to them. Raman?
Yeah. Thanks, Tariq, and good morning, everyone. We covered Bahrain's economic substance rules in last month's webinar, but I would just like to flag that the Ministry of Industry, Commerce and Tourism, MOICT, is continuing to issue violations to those who have not filed the economic substance returns. So by way of a quick recap, all businesses that have a commercial registration number in Bahrain and are carrying out a relevant activity. By the way, these activities were issued in a listing by the NYCT way back in June. These businesses are required to comply with certain tests and file their returns by 30th June 2020. Over the last couple of months or so, we've seen that businesses are still relatively unaware of some of these rules. For instance, a couple of weeks back, one of my clients reached out to me because liquidation proceedings for one of the companies was put on hold because of the ministry issuing a violation. One last point on the penalties. The regulations do stipulate that they can be as high as up to Bahraini dinar 100,000. However, thankfully, it seems that the ministry is adopting a more lenient approach, maybe because of the challenging circumstances at the moment, and this being the first year that ES has been implemented. So we strongly advise that key decision makers do take this opportunity that's being presented by the ministry to assess if they do fall within the rules, and of course, if they do, to comply and file the return as soon as possible.
Great, thanks, Raman. So before we move on to Saudi, we thought we'd cover a quick case study about the capital asset adjustment schemes that are applicable across the jurisdictions, because we seem to get a lot of questions around how the capital asset adjustments work. So firstly, what is a capital asset? In Bahrain and Saudi Arabia, a capital asset is a tangible or intangible asset that is assigned for long-term use as a business instrument, and it is not stock for resale. So it's not trading stock. The UAE has a slightly different definition, and it brings in a monetary threshold. So it states a capital asset is a single item of expenditure amounting to 5 million dirhams or more, on which tax is payable, and has an estimated useful life equal or longer than either 10 years or 5 years, depending on the type of asset. So unlike Bahrain and Saudi, there is a monetary threshold in the UAE in order for the asset to qualify under these capital asset adjustment rules. So how long do you need to monitor the use of the asset? Tarek will talk about why we need to monitor the use, but there's timeframes that depend on the type of asset. So in Bahrain, if you're dealing with intangible assets or movable tangible property, then you have to monitor the use for 5 years and 10 years for any immovable tangible assets, so like real estate. Saudi is similar in the sense it's 10 years for real estate and fixtures, but 6 years for all other types of capital assets, so movable and tangible goods. UAE has 10 years for buildings and 5 years for all other types of capital assets. So I guess the rules are somewhat consistent across the jurisdictions in relation to the period of time that you need to monitor the use.
Thanks, Mark. So the question we ask normally is, when do I need to start monitoring the use of the capital asset? Now, when you purchase an asset, that is always year one for calculation purposes. So if you purchase an asset in 2020, then year one is 2020. So when you buy the asset, you recover the input tax on the basis of expected use of the asset. And then you need to monitor this over the adjustment period, 5 years or 10 years, as Mark was saying. How do you make the adjustment? So there are specific formulas in the VAT laws, but essentially the aim of the rules is to compare the amount of input tax initially deducted at time of purchase, which was based on the expected use of the asset. And then you compare this against actual use of the asset. At the end of each subsequent year of holding the asset, what you would need to do is calculate what percentage of input tax was recoverable in relation to the asset. You would then compare this percentage against the percentage of input VAT recovered on the acquisition of the asset. Now, usually there's two positions. Either you've claimed too much or you've claimed too little. And either way, you will need to make an adjustment. So if you've claimed too much, you'll need to pay some money back to the tax authority and vice versa. There are some special adjustment events. So if these events take place, then you would need to make an adjustment pretty much straight away. So for example, you buy an asset and then you sell the asset, you destroy an asset, you join a VAT group, you deregister for VAT. So taxpayers need to be aware of the adjustment requirements should one of these special events take place. Taxpayers also need to maintain a register of the capital assets. So at the end of each year, you need to reassess the actual use of the asset for that year and calculate whether an adjustment is required. Now, if a special adjustment event does occur, then obviously you would need to make an adjustment. A lot of companies do ask that, does it apply to me at all? I mean, I'm making fully taxable supplies. If you're only making fully taxable supplies, then you would still monitor it for non-business use or any other use. But if it's only for taxable business use and nothing else, then it's quite likely you won't need to make an adjustment. But it's good to be aware of it anyway.
Yeah. And I think in those circumstances, you should still maintain a register of your capital assets and still conduct the exercise every year to see whether the change in use has happened, because you never know. You might, in year one, you might not foresee making any exempt supplies, but then your business entirely changes in year 4 and you're suddenly making exempt supplies, and you might need to pay back some of that input VAT you claimed right at the start. One point just to note before we jump to Saudi, when you purchase the capital asset, you need to recover the input VAT under the normal rules as at the time of purchase. So just because it's a capital asset, don't restrict your input tax recovery for any reason other than the fact that you don't make taxable supplies. It just follows the normal rules.
Yeah, that's right, Mark. So just a quick point on that. There's a taxpayer who have sort of purchased a capital asset and they intended to use it over 5 years. So what they did is, instead of recovering the input tax, according to the normal input tax recovery rules, what they did is they only recovered 20% of the input tax that they were entitled to, thinking they need to capitalize the capital assets. But capitalization, obviously for capital assets, doesn't work the same way as for accounting. So that's something to be aware of.
Okay, so moving now to Saudi Arabia. Earlier this month, Saudi Arabia made 2 important announcements. Firstly, the introduction of a new tax, the real estate transfer tax, or the RETT or RET, which also coincided with the exemption of real estate sales and transfers from VAT. The second announcement was the extension of the Gazette amnesty period to 31 December 2020. So let's start with the RET. So the RET was announced on the 2nd of October to take effect from the 4th of October. So it means it's already in effect. It's a 5% tax that is payable on transfers of real estate. Types of transfers that are covered by the RET are property sales, hire purchase arrangements, and finance leasing. So where you have that title transferring to this real estate, the RET is likely to apply. It's different from a VAT in the sense that the cost of the RET is generally irrecoverable for the purchaser, unless the purchaser is a licensed real estate developer. Whereas with VAT, you would have had to have looked at whether the purchaser is registered for VAT and makes taxable supplies, and whether it can recover the 15% that would have been charged. So as a result of the introduction of this new tax, for VAT purposes, transfers of real estate are now exempt. So before they were at the standard rate, so they went from 5% to 15% from the 1st of July, but they're now exempt. There are a number of exemptions to the RET, and Raman will talk through those more later. But they're, as you would expect, distributions among family members, wills and estates, and charities. Leases of real estate are still covered by the VAT law, and they will be out of scope for the RET. From a practical point of view, the Gazette has already updated their online portal. So if you're making a property sale or purchasing, then the seller will need to make sure they register the transfer online, and there will be a mechanism where the Ministry of Justice will check that the RET has been paid before it notarizes the transfer.
Thanks, Mark. So a bit about Gazette amnesty. Some of you may be aware that the Gazette amnesty has been extended from 30 September to 31 December 2020. Taxpayers have now got until 31 December to disclose any errors and pay any outstanding tax liabilities. Now, as part of the deadline extension, the Minister of Finance has also stated that any fines or penalties that have been imposed by the Gazette in relation to a point that is currently being appealed or objected by the taxpayer will be waived under this amnesty. So that's providing that the taxpayer pays a liability and withdraws the appeal or objection. So taxpayers really need to weigh up carefully the risk and reward of continuing with objections against the benefit received from the penalty waiver. It's a really good initiative, and we've seen many clients benefit from having their penalties waived. So there's a lot of historic issues, and it's a good time to sort of bring everything up and just get it, sorted, and then you can move forward with a clean sort of slate. A bit about e-invoicing. The Gazette has released draft regulations for electronic invoices. Now, our analysis of this and other imminent changes is that all Saudi resident taxpayers will be required to issue electronic invoices in future. Now, electronic invoices are not just scanned copies of paper invoices like the PDF documents that we normally see, but they will be documents that will have to be generated electronically in accordance with strict technical specifications. Taxpayers can also provide their comments on the draft regulations by 17th of October.
Thanks, Tariq. Raman, do you want to give us some more background on this new tax?
Sure, Mark. Yeah, as you've already said, that current and future sales of real estate property would now be subject to RET at 5% as opposed to VAT at 15%. The RET is payable on the higher of the book value or the purchase price or the open market value at the date of disposal. The RET is payable, obviously, from the seller's point of view. He needs to register the property transfer on the Gazette online portal and settle the due tax before the official transfer of property takes place from the seller to the purchaser. Again, as Mark has already mentioned, the transactions that are subject to RET, and he also mentioned some of the exemptions relating to close family transfers and transfers under under a will or an estate. I would also like to add that transfers to government bodies is also exempt from RET. There is also a penalty regime that has been introduced, namely, if you are late in the settlement of the RET, there's a 5% penalty for each month of delay in payment, which can increase to up to 3 times of the unpaid tax if the Gazette determines that there has been a deliberate attempt to avoid the payment of the tax. One final point on this, and it's clearly aimed at supporting Saudi citizens to climb up the property ladder, and that is that the Saudi state will bear the tax on the first purchase of a home by its citizens up to an amount of SAR 1 million.
One thing I noticed as well from the regulations is that the exemptions actually, the way that they're applied is that first the tax needs to be paid and then you later apply for the exception. So that's obviously going to be a bit of a cash flow impact for transfers. So you still have to pay the rent and then you later seek reimbursement of it. So it'll be interesting to see how long that takes. Raman, any other changes for Saudi?
Well, actually, in the past month or so, there hasn't been any significant changes in the direct tax world. So I want to take this opportunity to spend a few minutes and share with you a live experience, a real life case that tests the application of whether or not a capital gain arises on an inter-group transfer of shares. So here we have a non-resident company, which is a client, has transferred its entire shareholding in an entity that is registered in Saudi to another company within the same corporate group. The company did not report the transfer as it considered the transfer to have met the conditions, the qualifying conditions of an internal reorganization, and therefore under the tax rules, the capital gain should not arise. However, when the Gazette came out for an audit, they took a different view and have assessed a capital gains tax liability of 14 million on the transfer. Obviously, the client was not pleased about that because he followed the tax laws, and which I'll be speaking in just a second. But he filed the first appeal, which was rejected by the Gazette, and now the client has decided to file a further appeal for the case to be heard in front of the appeal committees. So clearly the point in question is, what are the conditions that are required to be met to qualify as an interim reorganization? Well, under the Saudi tax law, there are two conditions. One, both the purchasing company and the selling company need to be part of the same corporate group. And secondly, the asset, in this case, the shares, should not be sold to a member outside the group within 2 years from the date of transfer. Now, in this instance, both these conditions were met. So if you strictly look at the tax law provisions, the client's position is strong. However, what happened was that in May this year, the Gazette released a circular where they've added a third condition whereby both the purchaser and seller have also got to be tax resident inside Saudi Arabia. Now, obviously, this is standard Gazette practice, but it doesn't have any backing from a tax law perspective. The client has obviously decided to take this forward because they believe that not only this practice contravenes the tax law, but again should only arise upon the eventual sale of the shares to a third party. And to be honest, I would agree. I mean, the fact is that the shares remain within the group. There's been no transfer of risks or undertakings. So the gain should technically arise only upon the eventual sale outside the group. But anyhow, that's where things stand. Obviously, besides the client and myself, I'm sure a number of foreign investors would be a bit nervous and waiting for a judgment on this particular matter, because this could set an important precedent of whether or not any such reorganizations by foreign entities doing business in Saudi Arabia will attract capital gains in the future.
Great, thanks, Raman. Moving now to UAE. So the Federal Tax Authority has released 2 business bulletins this month, and just yesterday a VAT public clarification on VAT-free special offers, and only this morning a public clarification on sole establishments. So we'll quickly touch on each of these. So the clarification on VAT-free special offers. So FTA is saying when you, if you have a retailer that promotes their goods as VAT-free, or a special offer saying no VAT payable, it's actually misleading because VAT is actually being charged to the customer. It's just the 5% is being absorbed by the retailer. So FTA is saying now that retailers should not advertise on this basis unless the product is zero rated. You can obviously, taxpayers can obviously provide discounts equal to the VAT amount, but it's incorrect to say it's a VAT-free sale. There's no idea of whether there's any penalties imposed, but it seems like the FTA is probably going to say that you're failing to publish VAT-inclusive prices if you say it's a VAT-free special offer. The second public clarification was on sole establishments. So the FTA has clarified that where a natural person owns a number of sole establishments, also known as sole proprietorships, you only need one VAT registration. So you do not need a separate one for each sole establishment. It's important to note that these sole establishments are actually different from, say, a single person company. They're not a separate legal entity. They just form, the legal entity still rests with the natural person. So that's what the FTA said on that. Education sector briefs. These are really high-level documents which kind of touch on the key issues at a very, very high level. So if you're in the education sector, be it primary, high school, and higher education, it's worth having a look, but I suspect you probably are already aware of these issues. Raman?
Thanks, Mark. Yeah, so we covered the economic substance rules in the UAE as well in the last webinar. They're similar to Bahrain. However, I would like to highlight 3 key changes that UAE licensees should now be looking at to see if they still fall under the rules. first one is in relation to some exemptions that were announced. So, for example, if you are an investment fund or a natural person or a branch of a foreign entity that pays tax on UAE income overseas, or if your business is entirely conducted within the UAE, then you're no longer subject to the rules. If you hold an intellectual property asset and receive income from it, or you are a distributor of goods or a service provider, then you need to look at the definitions of these activities as they've been slightly tinkered and tightened up for economic substance rules to apply. And finally, of course, the FTA has now been tasked with administering the ESRs. They will be the authority who will assess if the UAE business is compliant with the rules. And a mechanism has also been put in place whereby the Ministry of Finance will report any non-compliance with the parent jurisdiction of the UAE business. So I guess the recommendation or food for thought would be for licensees to look at these, particularly these three changes, reassess if they still fall within the rules. If they do, there's two requirements. Firstly, you need to file a notification, effectively informing the authorities that you fall within the rules. That, we believe, will be in a specific format that should be released by the Ministry of Finance very shortly. And finally, the first filing of the economic substance report itself for 2019 is due by 2020. And just like in Bahrain, there is also a penalty regime in the UAE. Now that varies quite significantly from 20,000 dirhams to 400,000 dirhams in obviously for repeat offenders or in severe cases of non-compliance. At this juncture, it is not clear what the UAE will do in terms of imposition of these penalties, whether they will strictly impose them from day one, or they will take the position like Bahrain has done and give perhaps the licensees more time to adapt and adjust to the new environment.
Thanks, Roman. Moving now to Oman. So the draft VAT law has been with His Majesty for approval for about a month now. So there's still no certainty on the implementation date, but it could be as early as Q2 next year. On excise tax, the 50% excise tax on sweetened beverages, which was announced earlier this year, took effect from the 1st of October 2020. Roman, anything from income tax?
Sure, yeah. So in late September, Oman passed a number of amendments to its tax law. And I just would like to quickly highlight a couple which strikes the eye. One is with regards to the filing of the income tax return. So up until 31st of December 2019, taxpayers are required to file a provisional return followed by a final return within 4 months of the end of the previous fiscal year. This has now been changed with effect from 1st of January 2020, and therefore there is just going to be one return that is required to be filed within the 4-month period. Oman has therefore brought this filing obligation in line with what we have in Saudi. And the second one is the law has expressly stated who is a tax resident for the application of the tax law. So if you're a natural person, if you are spending a minimum of 183 days in a fiscal year, and that includes consecutive or non-consecutive periods of presence, you will be deemed a tax resident. If you're a legal or a judicial person, if you are incorporated in Oman, or if your key decision makers are sitting in Oman and taking decisions from there, then you will also be considered a tax resident.
Looking now at the other two GCC countries. So from Kuwait, there's nothing new on tax or VAT. In Qatar, the online tax portal, the Deriva portal, is now up and running. So this is the new portal. So if you were previously registered under the older tax authority portal, you need to make sure you're now registered under the Deriva portal. Other than that, there's nothing new significant on tax or VAT in Qatar. So that concludes the information part of the webinar. We've had a few questions. I've tried to follow them as we've been speaking, but we've still got 15 minutes. So if you have questions, there's a Q&A widget on the Zoom screen. So ask any questions you have, and we'll go through them now. Han, Dinesh, I don't know if you've been answering as we're going, but let me just open them up and then we can just go through them. I see you've answered 6 already. Okay. So first one, do all companies in Bahrain have to submit an economic substance return?
Good question. All companies that are registered with the ministry, so they have a commercial registration number, and they undertake a relevant activity. Now, in June this year, the Ministry of Industry, Commerce and Tourism released a list of qualifying activities. So if the activity under your CR list, that activity is on that listing, then you're required to file an economic substance return.
Okay, next one's about e-invoicing. Do you have any information about e-invoicing regulation? Do we mean to have all invoices in electronic format, or is it a special platform that's approved by Gazette to issue e-invoices from there? Tariq, what do you think?
Well, the e-invoicing is a bit of a peculiar one because if you look at the regulations and the law as it is, I remember it saying that you needed approval anyway, but I don't know any taxpayer that's received approval or even requested approval from the tax authority. So the main thing is that your invoicing is sort of complete. No sequence is missed out for now. And if any sequence is missed, you should be able to demonstrate why, for example, invoice has been cancelled, or there's been an internal error or an adjustment. So you should be able to evidence what's happened. If you can't evidence, obviously, then that's probably problematic.
Yeah, so the rules, they kind of work hand in hand with the VAT rules. So under the VAT law, you need to issue a compliant tax invoice. And now these e-invoicing regulations are saying, from what it appears, every Saudi resident taxpayer needs to issue invoices through an electronic means. So what that means is using, say, an accounting system or an ERP system that can generate invoices to certain specifications such that they can't be adjusted retrospectively, they can't be amended. You need to have that security aspect. There's no set platform at the moment. I guess really there's no guidance. There's only a draft regulation that is out for comment from taxpayers. So taxpayers can provide comments on it until the 17th of October. So if you do have any comments, feel free to reach out to us and we can help you make a submission. But it does seem like it will apply to all Saudi residents. Question around, can you provide us brief information about the VAT deferral during imports into Saudi? How should we declare such VAT amount in our VAT return? And how do we calculate the tax base?
So the VAT import deferral, I mean, at the moment, the customs authority in Saudi shouldn't be applying import VAT. So what taxpayers would have to do is report the imports on their VAT return. Now, when you report import VATs on your VAT return, you're actually reporting the output tax and import tax at the same time. So the net position is nil. I think Bahrain also has the deferment scheme for import VAT, but I'm not aware of any clients that have received that yet. But what I would take away from that is go back and check if you've made any imports, just to make sure they're actually being declared in your VAT return. And it'll go into field 9 of the VAT return, normally where you report import of services. That's what would be reported.
Like the reverse charge.
Like the reverse charge of services, yeah.
Great. A question about capital assets. So if a capital asset was purchased in December 2019, is the first capital asset adjustment to be made in December 2020? So this will be the first year is the year that you buy the asset. And then what you do is you compare it against subsequent years. So that would be this is the second year. So you would need to, in December 2020, look at that capital asset and adjust it if the change in use has changed from when you first recovered input back.
There's just a quick point about that, Mark. So with capital asset adjustments, depending on which country you're in, sometimes you're allowed to do it in the last tax period of the second year or the first tax period of the third year. But some tax jurisdictions, you have to do it in the final tax period of that year.
So that's a good point.
Yep.
Good point. Question, are there any plans to increase VAT percentage like in Bahrain as it was increased in Saudi Arabia? At the moment, we haven't heard anything. There's no indication either way on whether there would be an increase either in Bahrain or in the UAE. I think it's gone quite silent on it.
But then that's a good point, Mark. But when Saudi introduced 15 ton, I don't think anyone was expecting that either. What do you think?
True. No one in Saudi was expecting it. So I think it caught everyone by surprise. But look, from a practical point of view, if once the borders open and there's free movement, it would be very difficult to have two different VAT systems with different VAT rates on similar products. I could see a way to kind of get around the rules a bit. So I would expect they would have to meet somewhere.
Yep.
How do you report refunds when related to zero-rated sales? So if you have a zero-rated sale and then you later process a refund, how do you report the adjustment?
Oh, you would just put it in the adjustment column of the same. So if you report zero-rated supply, it goes in amounts column, and then the reversal of that would just go into the adjustment column.
Yeah. Unless I guess if it's in the same tax period.
Then you would report it in the same amounts column. You just net it off there. Yeah, that's right.
Why is a scanned invoice not an electronic invoice? What is the difference? So what they're getting at is the ability to manipulate a document. So if you've got a scanned paper invoice, then you can easily amend that paper invoice and rescan it in. An e-invoice is one that you can't adjust after it's issued. So that's what they're getting at.
Yeah, just quick about this invoicing. So other tax jurisdictions, they have requirements as well, like invoicing, they have software providers that are approved. And then invoices have to be issued via approved software vendor. Obviously, I don't think there's anything about that in Saudi or Bahrain yet, but it may come sort of at a future time.
Yeah, they haven't said. There's a question here about SAP and whether that will fulfill the requirements. At the moment, the regulations don't say anything. My gut feel would be that a big ERP system like SAP and Oracle would meet the requirements because they do in other jurisdictions. But we haven't seen that yet. For KSA, am I allowed to issue an invoice in July at 5% for one-off supplies made in June? So I think what this question is getting at is the transitional rules for the increase for the VAT rate. So what you need to look at is whether you have an existing contract with your customer and whether you can meet the contract rule, which says that if you're making a supply under a contract signed before the 11th of May and the customer can recover that in full, then you can charge that at 5% under that contract until the earlier of the end of the contract, the renewal, or 30 June of next year. So have a look at that. If you don't have a contract, then if it's a one-off supply that was totally completed before 30 June, then it should be still 5%. You would just need to note that on the invoice though. If I sell a capital asset in year 3, who has to repay the input VAT, the buyer or the seller? So that's, I guess, a question around how the adjustment rules work. So the adjustment rules for capital assets are on the purchaser. So you're a taxable business, you're registered for VAT, and you've purchased a capital item. At the time of purchase, you need to determine whether your recovery percentage on that. So if you're making taxable supplies or if you're using that asset to make taxable supplies, then you should be able to recover all of the VAT that you paid on that capital asset. But then every year for the next 5 or 10 years, you need to look at what did I use that asset for in that year. So say in year 3, you need to sit down and say in year 3, I used this asset for 100% taxable supplies or 80% exempt, taxable and 20% exempt. And if that percentage has changed from what you initially recovered in the year one, then you might need to repay input tax. You might be able to recover more input tax because the use of that asset has changed. So that's what you need to do. You need to monitor that. A couple of other questions. We've still got 5 minutes. So if you have any other questions, please feel free to ask. What tax rate applies to capital gains? I think it's talking about Saudi.
Yeah, the capital gains is taxed at the same rate as corporate income tax in Saudi, so that is 20%.
Great. Do we need to pay VAT when importing goods from another GCC member state?
At the moment, so all tax jurisdictions don't consider any other tax jurisdiction as an implementing state. So for example, if you import goods into Bahrain, then it doesn't matter where it comes from, they will impose import VAT. And then obviously you'd have to think, well, whether you can recover the import VAT depending on your supplies that you make. But they don't consider, like for example, Bahrain doesn't consider Saudi as an implementing state or UAE as an implementing state. So it's considered as any other country at the moment.
Great. We have a question about UAE VAT-free items, but I'm not sure I understand the question. Does VAT will not be applicable excluding of the value of the supply? So if you could maybe just rephrase your question or send us an email later and we can answer that, because I'm just not sure on what you're getting at. A question for Saudi. If a shareholding percentage changes, do these changes need to be reflected in the company's ERAD account?
Yes, that's correct. So if there's a change in shareholding, the company would have already amended their article of association to reflect the change. And consequently, you do need to log into your account on ERAD and update it to be in sync with your article of association.
Okay, so I think I got a bit of clarification on the question from the UAE. So as per yesterday's clarification, does the discount will not be applicable on excluding of value of supplies? So what that clarification was about is saying, if you're a retailer, you can't just go and say that you're selling an item as a VAT-free discount or a free of VAT sale when it is in fact a taxable supply. Because what is in fact happening is you are charging VAT on that sale, but you're just discounting that sale by 5%. So the customer is still paying VAT, but you're just giving them a discount. And providing discounts is fine, but I think the FTA's problem is the misleading words of it and contrary to the requirement of having to put prices as inclusive of that. So if you're selling something to a private individual, you must quote your prices as inclusive of that. So the customer must know the VAT inclusive amount. So just because it's VAT free, is saying something's VAT free because it's a 5% discount is incorrect.
Quick one, I mean, I've seen some people advertising VAT on us. That's obviously not saying VAT's free, so that's probably okay, where you'll say you'll take the VAT hit,
yeah,
the additional VAT,
yeah,
as part of the supply value. So
yeah, you can say that, but you need to just make sure if your published prices are always inclusive of that. Okay, so this is we've got 1 minute left. I'll take one more question. So if I'm not a licensed real estate broker, how can I reclaim RET? So the RET is obviously different from the VAT in the sense that it's generally irrecoverable by the purchaser. But if the purchaser is a licensed real estate developer, then they can recover the RET that they're charged. So it won't be a cost. Unfortunately, it seems for everyone else, you have to pay and you can't get any recovery on it because it's different from a VAT. But in saying that, we're still waiting on guidance from Gazette, so which we expect to be released either this week or next week. So that should clarify this point. Great. Look, that kind of takes us to the 45 minutes, which we don't want to go much longer because it's meant to be a very short webinar. As I said, if you aren't already part of our Tax Flash email list, please reach out to anyone from the team and we can get you on that list. It comes out every Thursday and it will keep you up to date with any changes across the GCC. But if you have any questions in the interim, please email us and we will get back to you.
We would like to thank all of you for joining in. We appreciate, obviously your time is precious, but we're delighted that you do join in, and we look forward to speaking with you next month.
Thank you.
Thanks.